Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be walking through the data for the quarter ended June 30th, 2021. Turning to the fixed income market, it was a positive quarter for fixed income, so it was really nice to see a reprieve from the losses that we saw in this space at the beginning of the year. And that's because interest rates actually came down. So the 10-year and the 30-year Treasury rate declined 29 basis points and 36 basis points respectively, so about 0.3% during the quarter, which when the interest rate comes down, the price goes up, and so you get a positive return in that scenario. The right chart shows attribution again, and so in the Navy, you can see the total return for each of those sectors and the excess return in orange, and then the currency return in green. And so for foreign bonds in total for the quarter, there was a positive contribution from currency. That's not always the case. If you look at the risky parts of the market, so investment grade bonds and high yield bonds, you can see that there was excess return, meaning that the spread over the Treasury came down. So the interest rates for those risky bonds are getting closer to the Treasury rate. That's what we mean when we say the spread. And so when that happens, their interest rate comes down and the price goes up. So you can see that how that's compared over time on that bottom chart. This gives us a good update on the fixed income market. You can see year to date returns in fixed income are still largely negative, especially when we get into more of the risk-free Treasury market at the top. Tips are still positive for the year. And when you get into some of the riskier parts of the market, like convertibles and US high yield and asset-backed securities, you can see a little bit of positive in fixed income for the year. I want to talk about inflation for a minute because I know it's just top of mind given the high numbers that we saw recently. And in May of 2021, headline CPI was 4.9% and core was 3.8%. And again, I wanted to mention that headline includes food and energy, which are more volatile, and so they typically get stripped out when we're looking at core. In May, you can see energy was up about 28%, so it moves around a lot. It can be really positive and really negative. So it's best to really focus on core when we're thinking about long-term trends. And 3.8% is still pretty high for core. You can see over time, ever since the early 1980s, inflation has been pretty well contained below 3%. And it ticked up a little bit higher. And the last time we saw a tick up like this was in 2009. And if you recall 2009, we weren't in an overheated, really growing economy at the time. That also was due to base effects coming off of a low base in 2008. So it's a similar situation here. But I know a lot of people are getting nervous because the numbers look high, and I think what really remains to be seen is if we are going to have inflation persist. And so the two big parts of the equation for inflation are the money supply and the velocity of money. And certainly during the pandemic, monetary policy was very easy, it continues to be. And fiscal stimulus was unprecedented. We had never seen that much money from a fiscal standpoint poured into our economy and deployed so quickly. So this was all done, of course, to make sure that we didn't go into a depression, to make sure that liquidity was still in the system, people could get money out of banks if they needed it, and to really stave off a panic. But now that we're coming out of it, we don't want to see a lot of inflation. So while the supply of money did increase pretty significantly, you can see that top chart in the Navy, you see that supply tick up, that's called M2. The rate at which is spent in velocity there in the orange actually is still really low, and that's really important. So velocity speaks to how quickly money moves throughout the system. And it's been coming down over the last few decades. And part of that is due to the wealth gap has been growing. And so if you think about lower income people tend to spend a higher percentage of their money than higher income people. And people at the very top end of the wealth spectrum tend to save a lot of their wealth. They don't spend it. So if money is sitting in a bank or savings or somewhere where it's not being spent and it's not moving through the economy, that slows the velocity way down and it tends to put a lid on inflation. So that's one of the things that I know the Fed is watching, is if that velocity is going to start to pick up again for some reason. It's a very complex issue when we're thinking about inflation, which is why inflation is just so difficult to predict, because we don't really know what velocity is going to do. It's expected to stay low given a lot of the dynamics that we have going on in our economy, but certainly something to keep in mind. Another thing that I know the Fed is watching is the employment situation. So the Fed has a dual mandate of stable prices and full employment. So there are two things that they have to keep track of. And while the economy has picked back up and price levels are starting to creep up a little bit, they still believe that that's transitory. And part of that is because we still do not have a healthy labor market. We still have 9.5 million people who are unemployed. And so you can see the unemployment rate had a really big spike at the very beginning of the pandemic and has come back down pretty quickly, actually, to 5.8%. But economists believe that once the economy reopens fully, once some of those really generous unemployment benefits roll off in September, once kids go back to school in the fall, there are just certain pandemic-related issues that once they roll off, there still will be people who will likely be looking for jobs, and it remains to be seen if those jobs will be there. A lot of labor market economists think that during the recession, during the pandemic, we permanently lost some types of jobs that just won't come back. So that's one of the things that the Fed is watching to see if those people indeed can find jobs, and that can maybe put some pressure on inflation, or if we're going to have an unemployment that is persistent for a long time. So stay tuned for that. One other interesting thing that we saw during the quarter is the personal savings rate. And I think this is just really fascinating because we were in a pretty deep recession and we actually saw the personal savings rate tick up, which does not typically happen during a recession. Usually during a recession, when you see a lot of unemployment, people dip into their savings to pay their bills, and that didn't happen. And that's due to the stimulus. So all of the money that was pumped into the economy to help, again, with bridge the gap between when the economy was shut down and when it reopened, led to people being able to save more of their income. So one other thing to keep in mind is if they do start to spend more of that, we might continue to see a little bit of inflation.